A bank approves a loan, and suddenly, money exists that didn't exist before. Not printed, not mined, not transferred from someone else. Created. Right there, in a quiet office, with a few keystrokes. And the strange part, this isn't a loophole. It's not corruption. It's not even hidden. It's the system. Now here's the uncomfortable question. If banks can create money like this, why does it still feel so scarce for everyone else? Let's slow this down, because this matters more right now than it ever has. Every time interest rates rise, every time inflation spikes, every time people argue about the economy, they're reacting to a system most of them don't actually see. A system where money isn't what you think it is. We're taught a simple story growing up. You deposit money in a bank. The bank keeps it safe. Then it lends that same money to someone else. Clean, logical, reassuring. It's also not really how it works. Here's what actually happens. You walk into a bank and take out a loan. Let's say $10,000. You sign the paperwork. The bank checks your credit. Everything looks fine. And then the bank adds $10,000 to your account. That's it. No vault gets lighter. No other account gets drained. The bank simply types a number into existence. At that exact moment, two things appear on the bank's balance sheet. An asset, your promise to repay the loan, and a liability, the $10,000 now sitting in your account. From the bank's perspective, this is balanced. From your perspective, you now have money to spend that didn't exist a few seconds ago. That's money creation, not by governments printing cash, but by private banks issuing loans. And this is where things get interesting, because most of the money in the modern economy, not coins, not paper bills, but digital money, comes from this exact process. Loans create deposits, not the other way around. Think about that for a second. The system doesn't wait for savings to appear before lending. It creates new money through lending itself. Now you might be wondering, doesn't that mean banks can just create unlimited money? Not quite. There are constraints, regulations, capital requirements, risk management, central bank policies. But here's the subtle twist. These limits don't stop money creation. They shape where it flows. And where it flows changes everything. Because banks don't create money randomly. They create it when they believe it will come back with interest. That means money is more likely to be created for real estate, large corporations, asset purchases, less likely for small, risky businesses, people without collateral, ideas without immediate profit. So money doesn't just appear. It appears in specific places and not in others. And over time, that shapes the entire economy. Asset prices rise. Housing gets expensive. Stocks inflate. While wages move slower. Not because of a single decision, but because of how money enters the system in the first place. Now let's talk about the part most people don't see. When a bank creates $10,000, it doesn't just create money. It creates debt. That money only exists because someone owes it back, with interest. So if you borrowed $10,000 at, say, 5% interest, you don't just owe $10,000. You owe more. But here's the catch. The extra money needed to pay that interest wasn't created in that original loan, which means, across the system, new loans have to keep being created to supply the money needed to pay off old ones. This is why credit expansion is constant. The system isn't designed to stand still. It's designed to grow, or at least to try. And when it slows down, when fewer loans are issued, when borrowing drops, something strange happens. Money stops being created at the same pace. But debt still exists. And suddenly, everything feels tighter. Businesses cut back. Jobs disappear. Spending drops. Not because money vanished physically, but because less of it is being created through new loans. This is why recessions feel like the air is being sucked out of the room. Because in a way, it is. Now let's add another layer. Central banks. They don't create money the same way commercial banks do. They influence the system. They adjust interest rates. They control the cost of borrowing. When rates are low, borrowing feels cheap. Loans increase. Money creation accelerates. When rates rise, borrowing slows. Money creation tightens. So central banks don't directly decide who gets money, but they strongly influence how much is created and how fast. And here's where the irony sets in. The system is often described as stable, controlled, carefully managed. But underneath, it depends on confidence. Confidence that loans will be repaid. Confidence that assets will hold value. Confidence that the system keeps expanding. If that confidence cracks, even slightly, the effects can spread quickly. Because remember, most money is tied to debt, and debt depends on trust. Now think about the last major financial crises. They weren't caused by money disappearing. They were caused by the realization that some of that debt might not be repaid. And when that belief spreads, banks pull back. Lending slows. Money creation stalls. And the system tightens fast. So when people say banks create money out of thin air, they're not wrong. But it's not magic. It's a structured process tied to debt, incentives, and risk. A system that rewards certain behaviors and quietly discourages others. A system where money is constantly being born, but always with a condition attached. Repay me, with interest. And if enough people can't, that's when the system shows its limits. Now step back for a second. This means something deeper. Money isn't just a neutral tool. It's a byproduct of decisions. Decisions made by banks about who is worth lending to. Decisions shaped by profit, risk, and regulation. And those decisions shape the real world. Who gets to buy a house? Who gets to start a company? Which industries grow and which struggle? All influenced by where newly created money flows. So the next time you hear about inflation, interest rates, or tightening liquidity, it's not abstract. It's the ripple effect of this exact process. Loans being created or not. Money expanding or contracting. Quietly, constantly, in the background of everything. And maybe the most unsettling part isn't that banks can create money. It's that the system depends on them continuing to do it. Because if money is born from debt, what happens in a world that wants or needs less of it